You're tuned in to More Living with Jim Brogan, broadcast live from the Brogan Financial Studios at News Talk 98.7, where old-fashioned values, expert knowledge, and genuine understanding come together to give you the retirement straight talk you deserve. Jim's a former National Advisor of the Year recipient and a financial educator, and he's here today to talk about how you can live out the best years of your life. Jim and the Brogan Financial team have been helping retirees and pre-retirees across the Southeast for over 20 years in their pursuit of financial independence. You can reach them during the week at 865-862-6800. So sit back, relax, and get ready to learn, because More Living with Jim Brogan starts now.
Hello, East Tennessee. Welcome to More Living with Jim Brogan, where it's all about living the best years of your life your way. As you listen to News Talk 98.7, WOKI, Tennessee is a no-income tax state, and living in Tennessee comes with a significant financial advantage that many residents don't fully appreciate or maximize, and that's no state income tax on many, many different levels. While other states continue to raise taxes and drive away residents and businesses, Tennessee remains one of only 9 states in the nation that does not tax your hard-earned income. But simply living here isn't enough. You have to establish proper residency. You need to structure your retirement income strategically and understand how to make the most out of this tax advantage. You know, recent data shows Americans fleeing high tax states for places like Tennessee. So now's the perfect time to ensure you're maximizing every benefit of living in the state of Tennessee. We're going to talk about a few things. We're going to talk about the Tennessee tax advantage and why residency matters more than ever. We're going to talk about retirement income strategy in a state with no income tax. We're going to talk about multi-state strategies for income and business strategies for Tennessee residents. And we're also going to talk about estate planning and gifting in Tennessee. And we'll get a little bit into the estate tax exemption. The new tax bill that was just passed makes a small change to that for our favor, or citizens' favor, to have less people taxed on their estates when they die. So recent data shows that we gained 30,000 new tax filers, the volunteer state, 30 new tax filers from interstate migration. So it's clear that people are discovering what we've already known, that the volunteer state is a financial haven. But simply living here isn't enough. Today we'll establish how to take advantage of this and make sure you have residency and all those kinds of things. So in the state of Tennessee, as of right now, we don't have any personal income taxes on wages, salaries, no taxes on retirement income. That means no tax on Social Security benefits, 401k distributions, IRA distributions, or pension distributions. Now, keep in mind, as I've said, this is state income tax, right? We certainly have federal income tax. But we don't also have a state income tax on top of all those things. We're only one of 9 states that's the case. There is no state level tax on investment income, interest, dividends, capital gains. We used to have a tax on certain types of investment income. It was called the Hall tax. It was enacted I believe in the 1930s, and we finally repealed it in 2021. So we don't have that anymore. And then we have no Tennessee state inheritance tax or estate tax, which is a really big deal and was also repealed a few years ago. And that was one thing that many legislators felt like was getting in the way of people wanting to move to Tennessee, was having the inheritance tax here. And so we have been able to repeal that, and luckily the lobbyists and the legislators were fortunate enough to realize that by not having that inheritance tax, it's an even bigger attraction for out-of-state folks to move here and to retire here. Now, as I mentioned, we gained almost 31,000 net income tax filers just from interstate migration. We are ranked 5th nationally for net inbound migration. As we know, Americans are moving from high-tax states like California, New York, Illinois, 18 of 26 states with below average tax burdens compared to the other states have experienced net inbound migration. So I do want to just talk a little bit about, making sure how do you make sure you have residency and can take advantage of this? Your primary residence must be in the state of Tennessee with the intent to remain indefinitely. And that's kind of interesting. It's Tennessee there's no set number of days. Your domicile is your true, fixed, and permanent home. So you must plan to live here with no plans to move. Spending a significant time in Tennessee strengthens your residency claim. While there is no specific time requirement, consistently residing in the state supports your case. New residents are required to obtain a Tennessee driver's license and register their vehicles within 30 days of moving to the state. That's an important feature. Voter registration and participation. Registering to vote in Tennessee and actively voting in state elections is a very strong indicator of state residency. Likewise, either owning a home or signing a long-term lease in Tennessee helps demonstrate a commitment to living in the state. Certainly, working in Tennessee or operating a business in the state helps establish residency. And finally, having banking and financial records, updating your financial accounts to reflect a Tennessee address certainly supports Tennessee residency. Now, many people own homes in multiple states, and that's where things can get a little tricky. Your residency status depends on which state serves as your primary home. While you may spend time in both locations, Tennessee residency is best demonstrated by where you live most of the year, where you vote, and where you conduct your financial and legal affairs. Some states, though, may tax you. Some states with income taxes may still claim you as a resident unless you have formally established Tennessee as your domicile, and that's very important. So if you have a second home somewhere else, you're probably fine if this has been your primary home. What if this is your second home and you're in Tennessee, but you plan to be here over 6 months a year? Where are you voting? Where did you file for vehicle registration? Did you move your bank accounts to local banks to be able to support all of those things? Now, what if you live in Tennessee but work in another state like Georgia or Kentucky? That those states do have income taxes. You may still owe income taxes on the wages that are earned there. Each state has different rules regarding non-resident taxation. So it's very important that you understand the rules in each of those states if that would apply to you. If you're living in another state but working in Tennessee, you generally are taxed where you live. Your home state may require you to report earned income in Tennessee. Tennessee is not going to tax you because we don't have state income tax on wages. But you need to check with your state of where you do live to see how they're going to do things. One of the best things that you can do, of course, is to find a professional. Working with a financial planner and a CPA and having a team, even an attorney that can connect all those dots is very, very important. Our lack of state income tax makes it a very attractive place to establish residency. Now, in our next segment, we're going to kind of dive into I want you to have perspective of what state income taxes look like in other states. And we're also going to talk about what if you work remotely? What if you live in Tennessee and you work remotely with a company that is domiciled in another state? How would that affect you? So stay with us. We're then going to talk about strategies to take advantage of our low or really no state income tax environment that we are blessed with here in the volunteer state. So stay with us. You're listening to More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back to More Living. I'm your host, Jim Brogan, as you're listening to News Talk 98.7 WOKI. We're so blessed to live in Tennessee. So many great things. I mean, the geography is so beautiful. My daughter is marrying a gentleman that is from New Zealand and was actually born in England. He's an English citizen, and he's just moved here. And now we'll tell you, New Zealand is an absolutely beautiful, beautiful place. We've been 2 or 3 times in the last 2 years since my daughter moved over there to date him. And it's a beautiful, beautiful place. The reason I'm bringing it up is because we've done a couple of trips with him. And we come home to East Tennessee, and he's just kind of like, man, it's just so beautiful here because it's so green and lush, and we have the lakes and the rivers. They've got the ocean, but here we have the lakes and the rivers. Geographically, it's just so beautiful here, and then we have no state income tax. So there are unique opportunities for retirement income planning that many Americans simply don't have. Retirees in other states face potentially devastating state taxes on their 401k, their IRA, their pension distribution. Tennessee residents can keep 100% of their retirement income. Now, when I say that, there is federal tax, of course, but there's no state tax on any of that retirement income, investment taxation, none of that. So today, let's talk about some strategies that can help you maximize the advantage and potentially save tens of thousands of dollars over your retirement. So as I said, there's no state tax on 401k withdrawals, IRA distributions, pension distributions, no state income tax on Social Security benefits. We're talking about a savings potential of between $2,000 and $5,000 plus annually compared to just average income tax states. So if you take a $100,000 annual IRA withdrawal, there's no state income tax here. Now, what about other states? Let's put this in perspective. Oregon has the highest effective tax rate. If you take a $100,000 distribution from your IRA in the state of Oregon, your state income tax is 20.4% effectively. That's your effective state income tax. Can you imagine a 20% income tax? So I'm looking here at the highest states from a tax perspective. These are state income taxes, okay? And the list is different for single filers than it is for joint filers. There are actually some states where it's really a penalty to be single. But just for the sake of this discussion, now when I said the 20.4% on a $100,000 IRA distribution, that was for a single filer. So the highest tax rate is 20.4%. Now, if you take $100,000 out of an IRA and you live in Oregon and you're filing jointly, your tax rate is 12.98%. It's right at 13%. That's a state income tax. Now, to put that in perspective, most retirees we serve are living in a federal marginal tax rate of maybe 22 or 24% in retirement now. You may not, many were not in that tax rate when they were working, but many of them are now. Some of them are in a 12% marginal tax rate. But let's just say 22, 24. You take $100,000 out of an IRA, and now you've got an extra 12 or 13% in state income taxes added onto that. I mean, that's in many cases increasing the tax burden by over 50%. That's remarkable. Hawaii's number 2 at 11.86%. Or let's call it a spade. I mean, a $100,000 distribution, that's almost $12,000 of additional taxation. Washington, D.C., Minnesota's number 4. So very, very low. Now, as I mentioned, we're one of 9 states that have no state income tax. The ones that are in the South, Florida, Texas, Mississippi. Now the other states that don't have taxes on retirement account distributions, believe it or not, Illinois does not have an income tax on IRA withdrawals. But that just gives you a little bit of an idea of what's going on around the country. We are very, very fortunate here in Tennessee. So let's talk about understanding how we can really plan for this. First off, I've talked often on this program and in the classes I teach about the sweet spot in tax planning. And that sweet spot where you really have opportunities, we've seen, is from after you retire and until you turn either 73 or 75 years old. Now, why 73 or 75? That's when you have to start taking mandatory distributions from your retirement accounts, and those distributions are taxed. Most, if not all, of that money will be subject to income tax. So you're forced to start doing that. If you're born before 1960, you have to start doing that in the year you turn 73. And if you're born 1960 or later, you have to start doing that in the year you turn 75. So think about it. When you retire, you no longer have earned income. You decide where you take your withdrawals from and how they're going to be taxed. You know, if I pull $5,000 out of my bank account, that does not trigger a 1099. I don't pay any tax on that. If I pull $5,000 out of an IRA or 401k, that is all taxable income. If I sell off a mutual fund if some of it is long-term capital gain and some of it is tax-free principal, it's a blend of the two. But see, we have unless you just have almost all your money in retirement accounts, which we do see some of that. But if you've got non-retirement account investments and retirement account investments, your decision of how to pull those out is going to determine your taxation when you retire. Your Social Security strategy will also determine your taxation. Now, I do want to do a little bit of a sidebar here. President Trump was saying, no, we're going to eliminate taxes on Social Security income. And that's a question I've been asked some over the last week since this new tax bill was signed into law. There was no fundamental change to tax rates on Social Security benefits. Literally no change. What the bill did in an attempt to provide retirees with relief is they raise the extra deduction you get if you're going to be 65 by the end of the year or older. You know, in 2024, it was $1,300 so per taxpayer. So if you were a joint filer, you know, if the standard deduction in 2025 is $30,000 for a joint filer, you get an extra $1,300 per spouse if you're both 65 or older for an extra $2,600. Well, now they've raised that to $6,000 per person. So that is substantial. Now that's on the deduction. So if you're itemizing, which 90% of Americans are not itemizing, but if you are itemizing and you're taking a bigger deduction, you're really not going to see any material impact on taxes on Social Security benefits. But if you are not itemizing, the idea is by having this extra $6,000 tax deduction that retirees today, seniors today, will have reduced tax liability on their Social Security. But that's only for the next 4 years. So that is not an indefinite thing. That does go away after, I believe it's after 2028. I'm pretty sure it's just 2025 through 2028. Okay, so it is important to know that because, you know, with Social Security taxation, the rates, the income amounts that were set, because you can, you know, if you're a joint filer and they use something called provisional income, and if it's over $32,000, then up to 50% of your Social Security is subject to income tax. And if you're over $44,000 of provisional income, It's up to 85%. The numbers that were used to determine those thresholds, one was developed in the early 80s, so it's been over 40 years. The other one was developed in 1993, I believe, so it's been over 20 years since that one was established. So those thresholds have not been adjusted for inflation for 20 to 30 years. So this new tax bill does absolutely nothing to impact the actual basic tax rates for Social Security, or how you're taxed on your Social Security income. And then that extra $6,000 deduction does go away after 2028. Now that's so, but your claiming strategy, obviously, if you delay your benefit, then that's money that's not showing up on your tax return. So you have a great deal of control of your taxation, potentially in this sweet spot between retirement and age 73 or 75, when you have those required minimum distributions from your retirement accounts. So that gives you a tremendous opportunity I like to call it fill up tax brackets. Many call it bracket management. Sometimes it's good to pay tax now, knowing that you're in a reduced tax rate from where you'll be tomorrow. So let's talk about that real briefly. If you're 67 and you're retired and you don't have to start taking your taxable IRA distributions until you're 73, you have a great deal of control over where you draw income from and how it's taxed. So you have an opportunity to keep yourself in a very low tax bracket. If you have large retirement account balances in your IRAs and 401ks, then that's potentially going to change when the 67-year-old turns 73. Because now they're going to have the forced mandatory distributions. And they're around, just ballpark, they're around 4%. Just so you can do quick math. So if you have $1 million in your retirement accounts, that's about a $40,000 taxable distribution. If you've got $2 million in retirement accounts, that's potentially an $80,000 taxable distribution. So you're going to lose some control of your taxation when you turn 73. In the meantime, you have an opportunity to keep taxable income low and then take advantage of filling up tax brackets at low tax rates. What does that mean? I'm going to talk about that when we come back from our next break. I'm going to talk about Roth conversion planning, and then what I consider one of the most overlooked areas in tax planning today, and that is intentionally generating long-term capital gains on your tax returns. So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
This is More Living with Jim Brogan, where it's all about living the best years of your life your way. This is News Talk 98.7 WOKI. You can catch us every Saturday, 9 to 10 a.m., and again from 3 to 4 p.m. You can also podcast all of our shows. You can stream them online at newstalk987.com, and then but our podcasts are posted on my website every Tuesday afternoon. You can go to broganfinancial.com and click on radio. Likewise, you can go to Spotify or Apple Podcasts, type in More Living with Jim Brogan, and you can listen to our podcasts. We'll have those up again every Tuesday afternoon, and we have our, about 2 years worth of shows podcast on those applications. We're talking about retirement income and the fact that Tennessee has no personal income tax on really any kind of income. I mean, we don't have a state income tax on wages and earned income. We don't have a state income tax on retirement account distributions from IRAs and 401ks. No extra state income tax on Social Security benefits. No investment taxation, dividends, capital gains, interest. And we have no state inheritance tax or estate tax. So we're a very, very friendly tax state. And we want to understand how to take advantage of this. So let's talk about this idea that I mentioned before the break of bracket management, understanding our marginal tax rate system and how you can potentially take advantage of the sweet spot between retirement age and age 73 or 75 when you take those mandatory taxable distributions from your retirement accounts. So let's just to try to keep this as simple as possible. Let's look at today's marginal tax rates. So it's important. I'm going to talk about married couples filing jointly, just to kind of keep this simple. The tax rates for single filers, literally the brackets are exactly half. So in other words, if your marginal tax rate for a 22% bracket for a married couple is $96,950, for a single filer, it's exactly half, $48,475. Let's talk about that number. 22% for incomes over $97,000. It's $96,950. Let's just call it $97,000. And remember, that's after the standard deduction. Or your itemized deduction if you're itemizing. But if you take a $30,000 standard deduction, that's added on to the $97,000. So now you're at $127,000. Then you get the extra $6,000 in the new tax bill. Now all of a sudden your taxable income can be pushing $135,000 to $140,000, or your total income prior to your deduction, and you're not even in the 22% tax bracket yet, which is pretty remarkable. So you could have well over $130,000 of total income on your tax return that would normally be subject to income tax. And by the time you take your standard deduction, and then if you're over 65, you take the extra deduction for seniors, all of a sudden you're looking at an effective tax rate of about 11%. I mean, understand our marginal system. The 10% tax bracket is on the first $23,850 we earn. So in other words, all of us, me, you, Warren Buffett, Bill Gates, we all pay the same tax rate on the first $23,850 we make. And it's 10%. Now that's after the deduction, so really you could say the first $30,000 is tax-free. Then the next $23,850 is taxed at 10%. Then when you get over that, you're in a 12% bracket all the way from, and I'm going to use round numbers, all the way from $24,000 all the way up to $97,000, you're in a 12% tax bracket. Then income above the $97,000 clicks you into a 22% tax bracket. So to put that in perspective, what if your income was $100,000 after your standard deduction? Then you only pay 22% income tax on that extra $3,000 that was in that marginal rate. So it's very, very important to understand all that. When we do our taxes every year, if you use a tax software, you use a CPA or an enrolled agent, oftentimes they'll tell you what your effective tax rate is. And it may be 16% or 17% or something, whatever it is. That's looking at all of your taxable income and saying, when you put in all these brackets, what's the effective rate on all of it? But that's not how our tax system works. We pay 10% on the first $24,000. We pay 12% on the next from $24,000 to $97,000. Then the 22% bracket runs all the way up to over $206,000. And then we've got the 24% bracket. Goes all the way up to $394,000. So in other words, and remember, that's after the deduction. So these tax rates are, in my view, and I've said this, in the last few weeks, I've said this both on Haller and Hilton Hill's program and on Phil Williams' program, that I don't think we'll ever see a lower tax environment than we see right now today. The rest of my life, I'm 55 years old. My daughter is almost 25. I don't think she'll see a lower tax rate in the rest of her life. Now, we don't really know that, but we know we have $37 trillion debt. We have huge deficit spending. And by the way, we're going to do a radio show upcoming in the next few weeks about how do we get our arms around the federal debt problem. We'll have a special guest for that. We're working on that right now. But the bottom line is, I don't think taxes will ever be lower than they are now. That extra $6,000 deduction for seniors goes away after 4 years in 2029. And then you add in the benefit of no income tax in the state of Tennessee at the state level. What a tremendous opportunity. So what's this idea of bracket management? That means that, if your taxable income, let's say, is going to be $70,000 after your deductions, okay, then you know exactly what it would cost you to do a Roth conversion. It would cost you 12%. If you're at 70,000 and you can go up to 97,000 in the 22% bracket, then you can do up to a $27,000 roughly, I'm talking round numbers, $27,000 Roth conversion, and you know exactly what that tax cost is. It's 12%. For those of you that are in that 12% bracket in that sweet spot in early retirement, that can be just a tremendous planning opportunity, because if you have large retirement account balances and you get to 73 and you've got to start taking out 40, 50, 60,000 of taxable income, you'll never see that 12% bracket again. Even if the rates stay as low as they are today, which I don't know that they will in 10 or 15 years. But even if they do, you're going to blow through into that 22% bracket when you get to age 73. So the idea of bracket management is you could look at filling up that tax bracket at 12% and take advantage of that. And on that $20,000 Roth conversion, it's exactly a 12% tax. Now, you do have to also understand, what if you convert a little bit too much? What if you plan it wrong? Because you have to do your Roth conversion by December 31st. You don't have till April 15th. So you've got to kind of estimate, what if you end up estimating wrong, and instead of having taxable income of $96,000, you end up with taxable income of $100,000. Well, again, you only pay 22% income tax on that small amount over the $96,950. So it's really not the end of the world if you go over that, but filling up a 12% bracket, to me, it's not a no-brainer, because it is an upfront tax cost, and you've got to look at, can you afford to pay that tax cost? How will you pay that tax? Will you pay it out of other dollars and not the Roth IRA? Now, the other big opportunity is understanding capital gains brackets, because up to that $96,000 number, any portion of that that's long-term capital gains has a 0% tax rate. So let's think about this for a minute. You could, as a married couple, if you're over 65 years old, you can have taxable income of up to almost $140,000. And any piece of that is a long-term capital gain is tax-free. Because remember, you've got a standard deduction of $30,000 plus the extra $6,000 per spouse in the new tax bill for the next 4 years. That brings your income all the way down well below $100,000. So any portion of that's a long-term capital gain is taxed at 0%. So let's go back to if I'm 67 and I have $70,000 of taxable income after my deduction, I mentioned the Roth conversion strategy. An even better strategy to consider would be, I have a stock or a mutual fund that has a long-term capital gain, and I can sell that and realize that gain up to $25,000, $26,000 at no income tax whatsoever. Now you may say, well, Jim, what if I want to continue to own that stock? Well, that's fine. Just buy it right back. There's no limit on buying it right back when you have a gain. The only potential limits on buying a stock or a mutual fund right back limits are if you're doing it to do loss harvesting. So people talk a lot about loss harvesting, and that is an important tax strategy to look at every year in the fall. But capital gain harvesting can also be very, very powerful. Now, I keep talking about this bracket that goes up to 97,000 because it's 12%, and it goes to 22, and it's 0% on capital gains. But this is true even going up beyond that. I mean, as I mentioned, the fact that the 24% income bracket goes all the way up to almost $400,000 of taxable income for married filing jointly. And remember, that's after the deduction of $30,000. So, I would say all of those tax brackets are low. They are low historically if you compare them to where we've been in the past. They're not the lowest they've ever been. But historically, if you go back to 1914 and the Income Tax Act and you follow it all the way through to today, we're living in a pretty low tax environment. Then you add in the benefit of having no income taxes in the state of Tennessee. Think about that. I mentioned 13% in the state of Oregon for a joint filer on an IRA distribution. If you did a $100,000 conversion, that's an extra $13,000 in income taxes. We don't have to pay that here in Tennessee. So we really have some great opportunities, and I know I got a little bit into the weeds here, but I wanted to just walk you through what does bracket management look like when you manage your income taxes. How do you fill up those brackets at low tax rates when you are fearful you may have higher tax rates in the future? Now, it may be you're fearful of where tax rates are in 10 or 15 years, and it may just simply be once you're 73 and you start taking those minimums out of your IRAs and 401ks, once you start doing that, you're never going to see these low brackets again. Certainly brackets like 12 and 22, and certainly the 0% on long-term capital gains. So having a basic understanding of our tax brackets and how to use them in a smart way, we should really look at that regardless of where we are in our financial journey, whether we're starting right out of college or we're raising a family or we're empty nesters getting ready to retire or we are retired. Understanding our tax system and how to plan effectively for it is a tremendous opportunity, especially in the state of Tennessee. Now, we're going to get to our last break. When we come back, I want to talk about estate planning and gifting in the state of Tennessee and the new rules under the federal estate tax on the new tax bill that was signed into law last week by President Trump, and the fact there's no inheritance or estate taxes or gift tax at the state level in Tennessee. Stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Thanks for tuning in this week to More Living here on News Talk 98.7 WOKI. Check us out online, broganfinancial.com. We've got a ton of resources on there so you can make informed and prudent decisions to impact the quality of your life. You can listen to radio shows, retirement minutes, my dollars and cents segments, and then we've got blogs. We publish a blog every week. We also have an e-newsletter you can subscribe to where all we do is send out content and information. And again, that's so you can make better and informed decisions. To live a quality life and have more living in the best years of your life. Tennessee taxation, there really is very, very little. I mean, we have some business taxes. I haven't really gotten into that. But at a personal level, we don't have to worry about income tax. We don't have to worry about retirement account distributions. We don't have to worry about investments. We only have to worry about federal income tax. And then the same thing is true with estate planning. Tennessee's tax advantage do not end with your lifetime. They extend to one of the most important financial decisions you'll ever make, how to transfer wealth to your loved ones and your favorite causes. Many states impose crushing estate and inheritance taxes that can claim up to 20% of your legacy. Tennessee residents enjoy complete freedom from these state-based wealth-destroying taxes. Now, the new tax bill at the federal level does make a small change to the federal estate tax exemptions. So the question is, how much can you pass to your loved ones without an estate tax? Now, first off, there is no estate tax to worry about on the federal level or on any level when you leave money or give money from one spouse to another, as long as that spouse is a legal citizen in the U.S. They're a legal citizen. So what about when the second spouse dies, or if you're married, or when you die if you're not married? Right now in 2025, one person can pass $13.99 million to the next generation with no estate tax consequence. Now, a married couple automatically gets double, so just shy of $28 million. So those numbers have grown large enough to be not affect nearly as many small businesses and landowners, especially farmers. Think about that. A lot of small business owners and farmers might have accumulated a good bit of wealth in their farm or in their business, but it's not liquid wealth. And so when they die, if it's subject to estate taxes at 40%, oftentimes the families cannot keep the business or keep the farm because they don't have the money to pay the tax. And so that's why you see more and more discussion about, where these estate and inheritance taxes and what are they going to be in the future. Now, in the new tax law in 2026, they permanently reset to $15 million per person, so just a little higher than they are this year. And then from 2026 forward, they will continue to be inflation adjusted based on the cost of living adjustments in our Internal Revenue Code system. So $15 million per person, and it's going to start going up in 2027. In 2025, it's just shy of $24 million. So those are pretty substantial numbers, and then we don't have to worry about Tennessee estate tax and inheritance tax. Now, what if you have property in another state? What if you have property in North Carolina, or what if you have property in Florida? Property in another state is probated in the state in which it is owned. Okay, so if you have a beach property in Wilmington, North Carolina, or near Wilmington, that goes through North Carolina probate, and North Carolina it's a tax. They call it an assessment, but it is a tax, a percentage tax on anything that goes through probate. Florida has a probate tax on anything going through probate. So if you do have property in other states, you are potentially subject to a estate tax in those states on just those properties. Now, you can put those in a revocable living trust, and if that's done the proper way, it can potentially avoid the probate in that other state, and therefore avoid the tax on probate or the assessment. But it's very critical to understand how that works. But in Tennessee, we are just so blessed to not have any state inheritance tax. And it also gives us opportunity to do gifts to our kids. In 2025, we can give up to $19,000 per person with no tax implication. We can give more than that. We just have to file it against our future $14 million exemption. But we don't have to worry about the state of Tennessee, which is a really, really great thing. Today we've discussed tax planning, because greater income for you, less taxes means more income, so you can live the best years of your life your way. Thanks for tuning in this week. Many thanks to Wayne for engineering the show. Thanks to Jill for helping produce the show. You've been listening to More Living with Jim Brogan, only on News Talk 98.7 WOKI. Check us out online at broganfinancial.com. I hope you have a very blessed weekend.
The views expressed by Jim Brogan and his guests are not that of Cumulus Media. Any discussion of financial, legal, and tax planning strategies is not intended to be individualized advice and is general in nature. Always consult with your advisor for advice specific to your needs. This program's content does not represent a recommendation of any particular security, strategy, or investment by Jim Brogan or Brogan Financial Incorporated.